Gene Arensberg, coming to you on Wednesday, July 17, 2013. As you may have read, we attempted to produce a video last weekend, but a production malfunction rendered the video unusable. And while we can't resurrect that video or get back the 20 hours of work that went into it, we thought we could do a shorter video to capture the main idea of it. The main thrust of the video was the unusually large amount of unnatural speculative short positions in gold futures as reported in the CFTC disaggregated commitments of traders reports. Most people already know about the huge record high short positions held by the Spec funds, or as the CFTC calls them, managed money, following the worst bear market for gold since the 1980s. The producer merchants and swap dealers in the disaggregated COT report have extremely low net hedges on, with gold now showing a $1,200 handle. But I don't think very many people are aware that it is not just the Spec funds that have very high short positions on at the moment. There are actually 3 different classes of traders that have unusually high record or near record high shorts on for gold futures, as reported in the futures-only disaggregated COT report. First, here's the graph showing just the short positions of the managed money class of traders, the hedge funds, the commodity trading advisors, commodity pool operators, and other very large traders who trade futures for clients. As of July 9, with gold at $1,251, managed money traders reported a DCOT record high 82,060 contracts short gold. At the same time, the traders the CFTC classes as other reportables, very large traders who trade futures for their own book, not for clients, have hugely ramped up their gross shorts to a record high 61,597 contracts short. Meanwhile, although they reduced their shorts a little this past week, smaller non-reportables reported 35,128 contracts short, which is pretty close to their record high of number of shorts set May 28th. Remember, this is in an environment when the big hedgers, the producer merchants, currently hold their smallest net short position, their lowest number of net hedges in disaggregated COT history at just 15,128 contracts net short. And when the swap dealers have recently gone from being significantly net short, nearly 65,000 contracts net short just in March, down to a tiny 3,913 contracts net short July the 9th. Swap dealers are almost flat. So we have a situation where arguably the trend following specs, the managed money, other reportables, and non-reportables have a huge, unprecedented, and we would say overly high number of gross shorts, bets that gold will fall further. Combined, that's nearly 180,000 contracts of paper gold sold into the futures market. Short bets that better be right, because there's no way in hell that these traders have the gold to deliver into those contracts. And our main point, the key issue we attempted to deliver to all of you last weekend, was that if the gold price moves against these momentum-following short gamers, the exit door for that enormous short position might end up being awfully small. Certainly the graphs and the momentum indicators favor the bears at present, but our point is that with the Spec short position being so high, with so many of the Spec traders leaning to the short side, with U.S. bullion trading banks now showing a very large net long position and therefore apparently not expecting further downside for the price of gold, and with the unusual condition of the largest, best funded, and presumably the best informed traders of gold futures on the planet, the combined commercial traders in the legacy COT report, now showing their least net short position in 12 years, and as a percentage of the total open interest, that tiny commercial net short position is a minuscule 4.4% of all the contracts open, the lowest relative commercial net short position in at least 12 years. Well, friends, if gold were to get a material bid just ahead, and if it were to break out above key technical resistance, probably even if it was because of something out of the blue, even a geopolitical shock or an exogenous unforeseen material upset of the markets for whatever reason, then the short covering exit door might seem something like the one we're looking at now. So that was the main thrust of the lost video. Today, Dr. Bernanke testified before the House in his semi-annual Humphrey Hawkins update. The bears took advantage to press their case, knocking the recent gains for gold back a mite. But I'll tell you that if I was way short gold futures, the fact that gold has made several higher lows recently would make it a little bit more difficult to sleep at night. And until gold breaks down below that last important higher low on June 10th, I'd advise the bears to stock up on the sleep meds. No matter what though, long or short, as always, mind your stops. That's all for now. Thank you for watching.